We're going to do a quick year-end observations. We're going to look at the possibility of a Santa Claus rally, how this year could end, what that usually looks like historically, where we are now. Next month, I'm going to save the possibility of recession. There's a lot of data on that, but that's more of a buzzkill, so I'm going to save that for January as the new year outlook. So we're going to save that and keep it positive today. Current money flow, we're going to spend some time on, and just to see where things are and how it matches up with seasonality, because I think that's pretty interesting. And then finally, we have the Fed going to do an interest rate decision next week. I'm going to touch on that based on where they are, where they probably should be, and what they're going to do. So we're going to look at that finally. Let's start off with a chart from Ryan Dietrich at Carson Group, looking about seasonality when the Santa Claus rally comes. Now, historically, the Santa Claus rally really is the run between December 25th, actually Christmas Day, and actually about the second or third trading day of January. That is actually what it's referring to when it gets mentioned, or the original origin of it, that there tends to be a good run in that period. Everything before then is really just coincidental seasonality, but that's positive in that time frame. But typically, as you can see here, the market kind of drifts sideways like it's been. The market started off okay in the month, and then it's been drifting sideways and chopping, really just more sideways and choppy. But that is expected to happen until early next week. And then typically we get a more steady move upward into the end of the year with low volatility, with low drawdown. So that's something we're going to look at. If that does set up, then I'm excited for that. Interestingly, Rob Hanna at Quantifiable Edges did a study on this as well on his newsletter, read last night actually, that options expiration week, which is next week, is usually when the bottom hits for December and then runs up into at least Christmas, if not the Santa Claus rally period between Christmas and just after New Year's. So a lot of seasonality things, a lot of historical things are in agreement. As Rob Hanna says, that there's an edge to that, so that's worth keeping in mind of being invested or looking to be present and invested in that environment. Over the past 10 years, interestingly, the market does tend to drift, and this drifts down to about the 20th based on seasonality of the S&P, and then jumps up a bit more rapidly. So I'd be curious if we see a push down more into the options expiration, which is the end of next week, and then we get the run, and that's what this suggests, a different way to look at seasonality. But interesting to see if this could happen, and then we jump. And this suggests the last 10 years, we haven't had much of a post-Christmas rally, although it depends on the year. We've had a couple different scenarios which drove that in different directions, but it's certainly interesting to see that it's not as strong after Christmas. So the good run, at least in the last 10 years, has been from around the 20th to the 25th. So we'll have to see how that plays out and what we're going to do with that. Money flow. Money has steadily been pulling out of the market since really the first of this month, maybe even the end of November. This is what we call money flow, or somebody would say is breadth. So is money coming into the market? It's really not. It's really kind of drifting sideways. And that looks a lot like that. Even though the market's gone sideways, or even this here, it's kind of matching up that money's not really coming in aggressively. But that's going to really, for me, is one of those big triggers that if we start to see this spike, like it does here, then something's here. People are interested. There's money that's looking to be aggressive. And that's when you want to be a little bit more invested. But at the moment, we're just kind of, not on pause, but just cautious to see where this goes. But at some point, I'm really expecting a bottom to hit here, and then we'll have a good run. Doesn't have to happen, but again, that's typically what happens this time of year. All right. Seasonality, or not seasonality, our midterm cycle is a mix, a different way to take in market trends and money flow. It's been negative since about a week ago, and not great. I'm making some updates to this chart as well, I'll have it next year, but also looking at points of when it peaks and comes down a certain number off of a peak and even off of a bottom, that it may be worth starting to look at that money might be flowing in, but not enough. Because we always thought about this as below this line is money is net flowing out of the market and above is net running into the market. So if money is coming in, it's certainly fine. So even if it's coming in and slowing, that's not bad. But we've been finding that if it slows a certain amount, and we're kind of playing with what that number looks like, then it's worth looking at, okay, do we reduce a little bit here? Do we start getting cautious or not put new money in the market as well? You kind of wait for that, or this makes these much better entries. So we'll have to see how that plays out, but something we're testing, something we're updating for the future. All right, and sectors, they kind of agree that the market's kind of right now. So many sectors, especially the ones that are really getting wrecked, are healthcare. Healthcare has just been on straight down for the last months at this point. So yeah, nothing exciting there. Same with energy. Surprisingly, I thought energy probably would have seen a little bit better based on election results, but that's different as well. Same with financials. Financials had a great pop out of that, and they're struggling now. Right now, Our positive side is really just communications, technology, consumer staples, and discretionary. That's really an odd mix. This is usually one or the other, but just consumer staples is getting weak and has been running longer, so that might weaken the most. But XOY is consumer discretionary, free spending. People are spending money, and that's really the only strong trend over on the positive side, where we have several sectors in a strong trend, not on the positive side. So that I want to see this start to turn around, and you see it shift as this ties in with the other money flows. You start seeing these sectors move from negative to positive, and you go, okay, things are ramping up now. I think funny that XLC is basically the big tech companies as well. So this is really all just tech and consumer. And the biggest in XOY, I believe, is Amazon. So this is really just tech is back. Where it really struggled since July. And many markets have really kind of peaked out then and have really been sideways, including NVIDIA. I think NVIDIA is the same price it was mid-June at this point. So it's been a little bit up. It's had a good sell-off in that September, October period, and is now back to where it was. So just interesting to see a lot of markets have really been flat since the summer, with the exception of the S&P, which did get a pullback and it ground ahead. But you look at international, both developed and emerging, that really haven't done much. Small cap is just a big mess that's all over the place. So really hard to say. But and I saw an article saying that it seems like the U.S. is taking investment money from other parts of the world, because that's the only market that really has done okay in the last 6 months. Just fascinating change of trend. So I'm really curious to see how this flows into next year and what we look at going forward. Again, here's the rotation chart of the sectors versus the S&P, or actually versus T-bills, which again gives you a sense of where things are. If most sectors are up and improving and leading, you've got a pretty strong market. And when they start pushing down into this weakening area, like we have like all these 2, 3, 4, 5, 6, half the sectors, and even up here are starting to push down into the sell-off area. So that's not saying that the market is really strong. The best ones are when they all group into the lagging and jump into improving at the same time, and you get a very strong move out of that. Kind of fun, coincidentally, last night I hosted a webinar with Julius de Kempenaar, who created this chart, and we had some good insights on the ways to use this in the future. So I'm going to have some fun with this as well in future webinars. So finally, let's look at the Fed. I think this is going to be interesting. And this is a Tom McClellan chart, certainly a good friend to both myself and Will Hepburn on our team, known him for years, who does great work. And one of his best pieces, I think, continually is looking at what the 2-year Treasury note, the 2-year Treasury yield is versus the Fed funds rate, and where the Fed funds rate is. So the green line is the 2-year Treasury yield, and then this black line is what the Fed is doing. And the reality is they're always behind where returns should be. And that seems, when you really look at how their policy happens, they usually are. Like they should have been raising sooner back here in 2013. They should have cut sooner back in 2019 around the COVID crash. They should have started raising sooner in the 2021 area, and they were late again to cut. And they're probably going to cut, I believe it is a quarter point. It's a 98% chance. They're going to cut a quarter point that puts them right there. So they're probably going to be close to being in line to where they should be. But again, they've been late. So, usually when they are cutting, we're in a cycle of rate cuts. That's not the best time for the stock market. Right here, this was pre-COVID crash. This was 06, 07 before that happened, the financial crisis in 2001, before the tech bubble burst. So falling rates is usually not the best sign for the markets going forward. But again, I'm going to save that buzzkill for January.